What's up, guys? Today I'm going to teach you what a PE ratio is, or a price earnings ratio. This is one of the most popular things that investors will look at when picking stocks. And in this video, I'm going to show you how to calculate the PE ratio. Then I'm going to show you what a good PE ratio is, and then we'll finish it off by looking at an example of a stock with its PE ratio and if it's something that I would invest in.
All right, so what is the price earnings ratio and why is it important? So first we need to understand exactly what the formula is and define all the pieces to it. The first part is price. So price is the value of the company, or it could also be the market cap of the company, or it could be the stock price of the company. Earnings is how much the company makes, whether that be its annual profit, if you want to call it earnings, or if you want to call it earnings per share. That is the earnings portion of the formula. So price earnings ratio is the price, or what the business is worth, divided by its earnings, or how much money it makes. So it's price divided by earnings equals PE ratio. So why would we use the PE ratio? Well, it's to determine if a company is over or undervalued. Our goal as investors is to give money to a company and hope that we have a positive return on investment, whether that be through dividends or capital appreciation. So the beautiful part about the stock market is we have the luxury of choosing from multiple companies, hundreds or even thousands of companies. So we can determine which one is a better investment. But how do we decide if a company is a better investment when, say, one is much smaller than another? Just because a company is smaller doesn't mean it's not a better investment. And here's what I mean. We have business A and business B. Business A is worth $100,000. So everything within that building, including the building itself, everything the business is worth, if it were to go and sell it to someone else, it's worth $100,000. Business B, on the other hand, is worth $500,000. Business A makes $10,000 a year. Meanwhile, business B makes $25,000 a year. So just by looking at this, you might think business B is the better option because it's 5 times the size and it's making 2.5 times the amount as business A. But when you look at the PE ratio, business A has a lower PE ratio than business B. People like to look for lower PE ratios because that's a better bang for your buck. That means this business is making more money per dollar that it's worth as opposed to business B. So business B compared to business A might be a little overvalued. Now let's take this and let's look at an example within the market. So if you look at all the S&P 500 companies, the average PE ratio is between 10 and 15. But the lower the PE ratio doesn't always necessarily mean it is better. And what I mean by that is if you look at tech companies or these big blue chip stocks, some of them might have higher PE ratios. Their PE ratios might be in the 30s or 40s, but that's normal for them. That's normal for either the industry or it's normal for the company. So the most important thing is to not only compare two companies or compare a company within the industry, but also compare the company to its historic PE ratio. And I'll show you what I mean. So let's look at both Target and Amazon. Both of them are large cap stocks. Amazon's one of the biggest companies in the world. Target, even though it's not nearly as big as Amazon, we all know these two companies. So what we're going to do is for price, we're going to look at their stock price. For earnings, we're going to look at something called earnings per share or EPS. So its PE ratio is going to be stock price divided by EPS. And it'll get us the same as the PE ratio if we were to look at its overall price and its earnings. This is just a nice little shortcut. It's smaller numbers instead of looking at numbers that are over $1 billion. So for Target, its stock price is $118. And this data was pulled June 17th. So I'm recording this a day later. And Amazon's stock price was $2,640. So Target's earnings per share. So for every share that you own, that $118 that you own, you are making $4.97 off that $118. So its earnings per share is $4.97, and Amazon's earnings per share is $19.94. So if we look at their PE ratios, Target's PE ratio is 23. Amazon's PE ratio is 132. So if you're purely going off of PE ratios and which company is giving you the best bang for its buck, it is Target. So to visualize it a little differently, for every $23.80 that you invest into Target, Target will make you $1 in profit. Amazon, on the other hand, is for every $132 invested, Amazon will only make you $1 in profit. But just because Target's PE ratio is much smaller than Amazon's, it doesn't necessarily mean it's the better bet. And let me show you why. So we're going to jump over to Seeking Alpha. As you can see, this is now today's data. Target went down a little bit. It's $117. Its earnings per share, there it is, $4.95. And there's its PE ratio, $23.81. So what's great about all these different programs is it'll have this information for you, so you don't have to go and search for it or do any math yourself. So we're going to go over to the Value tab, and if we scroll down, we're going to go to Target's PE ratio. So this is showing Target's historic PE ratios for every single day for the past, we have 3 years. And you can see right now, it looks like it's a little overextended. It looks like maybe Target's a little overvalued, because normally it's jumping around 15 and 10. Right now it's in the low 20s, close to an all-time high for its PE ratio. So Target might be a little overvalued, and you might not want to invest in it yet. Maybe wait for its PE ratio to come back down. Now, if we jump over to Amazon, see it's $2,648. Its earnings per share is $19, and its PE ratio is 132. Let's click on Value, and if we scroll down to its PE ratio, over the past 3 years, you can see Amazon's PE ratio has been declining. It looks like it had a little bit of an uptick right here, but overall, it's been going down. And the reason why is because Amazon has continued to make more and more money, so its earnings has been able to slowly catch up to its price. So Amazon might be a better buy than Target if you were looking at PE ratios and looking at its historic data. So that's why, just because PE ratio is higher or lower doesn't necessarily mean it's a good bet. The best thing to do is to look at its PE ratio compared to other companies within the industry, or more importantly, look at its historic data. Look at where its PE ratio was in the past to determine if it is a good buy or not.
But that's PE ratio. It's really simple to understand. It's a great way to look to see if a stock is either overvalued or undervalued, and how you can compare two different stocks even if one is 10 times bigger than the other. Just because it's 10 times bigger, it might not be the better investment, and you could look at the PE ratios to make that decision. But you gotta remember, PE ratio is just one piece to this massive puzzle. There's a lot of other things that you can look at, and just solely focusing on the PE ratio isn't going to guarantee you a better return on investment. That's all I got for today. Let me know what you think. If this was helpful, give it that thumbs up. Subscribe if you haven't already. Make sure to leave a comment, and I'll see you in the next one.